Imagine you invent a brilliant $1 million machine, you sell it, you celebrate, and then you just never see that customer again until the machine breaks down like 10 years later.
Right, which is exactly the old way of doing business in heavy manufacturing. It's exhausting.
It really is. But what if you could sell that same machine and then get paid this incredibly lucrative subscription fee every single day for the rest of its operational life?
Now that is the dream scenario.
Welcome to Griffonomics. Welcome to this deep dive into a stack of fresh sources. We're looking at Q1 2026 earnings transcripts, 10K filings, and some really strategic analyst reports covering Agilent Technologies, ticker symbol A.
And we have a very specific mission for you today as we go through all of this material.
We do. We are generating a granular strategic report and investment roadmap. We're looking at how a company that's historically known for selling, heavy capital lab equipment is quietly transforming into a high-margin, recurring revenue powerhouse. They are essentially becoming a workflow essential for the world's biggest industries.
And it's such a critical pivot to analyze. Because while so many investors are out there chasing these flashy, high-risk biotech startups.
Oh, yeah, the ones crossing their fingers and just hoping for a miracle drug approval from the FDA.
Exactly. The real, reliable profits are quietly compounding somewhere else entirely. They lie with the companies providing the tools, the picks and shovels to the entire industry. Agilent supplies the instruments that make those miracles possible.
Okay, let's unpack this. To really understand the sheer market power Agilent wields right now, we first have to look at how they fundamentally changed what it is they actually sell.
Yeah, it's a complete structural shift.
I mean, think about it, like moving from simply selling an office a printer to selling them this lifetime contract for the ink, the special paper, and the on-site maintenance guy who practically lives in their break room.
That is the perfect way to visualize it. Agilent has successfully shifted its business model so that 65% of its total revenue is now entirely recurring.
Wow, 65%.
Yeah, we're talking about services, daily consumables, and software subscriptions. That is a massive jump of 700 basis points, which, is Wall Street speak for a 7% increase just since 2020.
That's incredibly fast for a heavy manufacturing company to pivot.
It really is. And crucially, roughly half of their total revenue is concentrated specifically in the pharmaceutical and biopharmaceutical markets.
Which completely insulates them from sudden freezes in corporate capital spending.
Exactly.
Because, if a pharmaceutical lab suddenly tightens its belt and stops buying shiny new multi-million-dollar machines, they still have to buy the proverbial ink and maintenance to keep their existing research running.
They have absolutely no choice.
But wait, why are they so locked in? If I'm a lab manager, why couldn't I just buy, cheaper off-brand ink from a competitor to save a few bucks?
Well, what's fascinating here is the underlying why behind that customer stickiness. The pharmaceutical industry is arguably the most heavily regulated environment on Earth.
Right. The FDA does not mess around.
Not at all. It relies on incredibly strict compliance and rigorous quality control. So once a specific consumable, say a chemical reagent or a software service, is validated within a lab's workflow, the FDA signs off on that exact process.
Oh, I see. So if the lab wants to swap out Agilent's product for a cheaper competitor, they can't just do it. They have to revalidate the entire process with the federal regulators.
Exactly. It becomes incredibly difficult and massively expensive to rip it out. It creates this huge revenue predictability for Agilent because the customer is locked in by their own compliance needs.
The cost and downtime of switching is just too high, but, a transition to that kind of recurring revenue doesn't just happen organically.
No, it takes a lot of painful internal work.
Right. It takes a complete rewiring of how a massive enterprise operates and allocates its capital. And that brings us to the strategic inflection point for Agilent, the Ignite operating system and their latest M&A strategy.
Yes, the Ignite system is central to this whole thesis.
But let me play devil's advocate for a second here. Management keeps touting this Ignite operating system. They claim it's driving 75 basis points of margin expansion. But when I hear operating system, I think of like Windows or Meco.
Sure, sounds like a tech product.
Yeah. What actually is Ignite in the context of a giant manufacturing company? Isn't it just corporate buzzword bingo for basically laying people off and cost cutting?
I get that. It is really easy to be cynical about corporate restructuring terminology. But Ignite is not just about trimming the fat. It's a permanent, enterprise-wide playbook for how they price products and run their global supply chain.
Okay, so how did they do it before?
Previously, Agilent priced their products bottom-up, It was almost at the individual product code level across all these different regions, which was incredibly fragmented and inefficient.
Oh, wow. Sounds like a nightmare to manage.
It was. Ignite shifted them to a unified, value-based pricing model across the whole enterprise. By overhauling that fragmented pricing, they actually doubled their pricing realization to 150 basis points in Q4.
So they're just getting a lot more money for the exact same products.
Precisely.
But how does an operating system help them physically dodge international tariffs? Because I saw notes in the sources about Ignite regionalizing manufacturing.
Right. So under the Ignite framework, instead of manufacturing everything in one central hub and then shipping it across borders, which exposes you to all those massive import taxes, they rapidly spun up regional manufacturing.
Got it. So if you sell a machine in Europe, you build it in Europe.
Yes. If you sell it in Asia, you build it in Asia. And at the same time, they reduced their internal divisional structures by over 50%.
Wow, half the division's just gone.
Yeah, that physically removes the tariff barrier and streamlines the whole company.
Okay, that makes a lot more sense than just a software update. And Ignite really seems to be the engine behind their newest acquisition. I see they just signed a definitive agreement to acquire Biocare Medical for $950 million in an all-cash deal.
It's a massive move. And the Biocare deal is basically the ultimate test of the Ignite system. Biocare brings over 300 specialized antibodies to Agilent's pathology portfolio.
And antibodies are consumable, right? They get used up constantly.
Exactly. And Biocare pulled in over $90 million in 2025 with double-digit growth. So Agilent is taking a high-growth, consumable-heavy business and plugging it directly into their newly streamlined ecosystem.
Because the Ignite framework already fixed the global pricing structure and the regional supply chains, I imagine Biocare doesn't require, a clumsy, years-long integration.
You hit the nail on the head. It's a plug-and-play scenario. Because of Ignite, Biocare is expected to be accretive to Agilent's top-line growth and margin in year one.
And to translate the finance speak for a second, accretive basically just means it pays for itself and starts adding to Agilent's overall profit margin immediately, right?
Exactly. It's a precision upgrade to their recurring revenue machine.
So Ignite proves they can integrate new companies cheaply and efficiently, but the ultimate test of any restructuring is what happens when a literal disaster strikes. Did this new resilient system actually hold up when it hit the real world in Q1 2026?
The numbers speak for themselves. They delivered a very solid beat on both revenue and earnings.
Let's look at the actual scoreboard.
Q1 revenue came in at $1.80 billion, which is up 4.4% on a core basis. And they did that despite a really severe U.S. winter storm in January.
Oh, I noticed that in the transcripts. That storm caused a surprise $10 million revenue hit right at the end of the quarter. Facilities and shipping routes were just completely frozen shut.
Yeah, but the underlying demand was so strong that they absorbed a literal force of nature and still beat Wall Street expectations.
That's resilience.
And off the back of that, management raised their full-year reported revenue guidance to between $7.3 billion and $7.5 billion.
Yeah.
They also increased their full-year non-GAAP EPS guide to $5.90 to $6.04.
Right. And for anyone newer to the financial jargon, non-GAAP EPS is just Wall Street's way of measuring the core profit per share without all the messy one-time accounting hiccups.
Exactly.
But when you look under the hood at the different divisions that make up that $1.8 billion, there is some serious divergence. How did the specific internal segments actually perform?
Well, we saw the Applied Markets Group, or AMG, outperform expectations with 4% core growth and a really strong 25.8% operating margin.
Okay, not bad.
The Life Sciences and Diagnostics Markets Group, LDG, lagged a little bit with 3% core growth and a 16.0% margin.
Right.
But the absolute standout was CrossLab, their services segment. CrossLab completely crushed it with 6% core growth and a massive 31.6% operating margin.
31% margin on services. So what does this all mean for you as a listener analyzing this space? It means that the massive margin in CrossLab proves the recurring services thesis is working beautifully.
It is the profit engine.
They aren't just selling the machinery, they are making an absolute killing on the daily upkeep.
Yes, CrossLab is the high-margin anchor holding the whole ship steady.
Yeah.
But you only sell maintenance and services if the labs are actually busy using the equipment.
That's true.
If CrossLab is the anchor, we really need to look at what is driving the sheer volume of scientific work feeding it.
Here's where it gets really interesting. Let's talk about GLP-1 drugs. These are the weight loss and diabetes treatments that are just taking the world by storm right now.
Oh, it's a gold rush.
It is. And Agilent saw a staggering 50% growth fueled specifically by GLP-1. Now, think of Agilent's strategy here like a casino. Agilent doesn't care which pharmaceutical giant wins the obesity drug war. As a supplier, they are completely modality agnostic.
That's a great analogy. Their revenue is indexed entirely to production volume. They really don't care about the ultimate retail price of the drug or whether the winning formula turns out to be, an injectable pen or an oral pill.
Right, as long as the volume of global manufacturing goes up, the house, which is Agilent, always wins.
Always. And they are building specific tools to make sure they capture that volume. For instance, they recently launched the Altura Ultra Inert LC columns.
Okay, before we talk about how well those sold, what actually is an LC column? Why do GLP-1 manufacturers desperately need them?
Good question. LC stands for liquid chromatography. Imagine you are brewing a massive vat of a complex, highly regulated drug like a GLP-1 agonist. You need to ensure absolute purity.
Obviously.
An LC column is essentially a highly advanced microscopic filter. You pump the liquid drug through this specialized column, and it separates out all the individual chemical components.
Ah, okay.
It allows scientists to measure exactly what is in the mixture and ensure there are zero impurities or dangerous byproducts.
So it is a mandatory quality control step. You literally cannot release a batch of drugs to the public without running it through these columns to prove it's safe.
Exactly. And Agilent's new Altura columns are highly sensitive and specifically tailored for this kind of complex biological analysis.
And the market response.
It was immediate. Within just 1 month of launch, those specific columns were sold to half of the top 20 pharmaceutical companies in the world.
Half of the top 20 in 1 month. That's unbelievable adoption. But it's not just biology driving this volume either. They are riding a massive wave in physics and engineering too.
Yes, they are.
That Applied Markets group we mentioned earlier saw 20% plus growth in spectroscopy, and that is a direct result of the global push to reshore semiconductor and battery manufacturing.
Right, because building microchips and advanced electric vehicle batteries requires intense material analysis at the atomic level.
Yeah.
If there's a microscopic flaw in a silicon wafer, the whole chip is useless.
Makes sense.
Agilent provides the specialized spectroscopy tools that analyze those materials, placing them right at the center of the advanced manufacturing boom.
Okay, so growth across biology and advanced materials is fantastic. But capturing growth is one thing. Keeping the customer and compounding the cash is another entirely. If you're looking at this as a long-term investment, how well a company traps value is just as important as how fast they grow.
Oh, absolutely. And Agilent boasts a customer retention rate of over 90%.
90%.
In a highly competitive enterprise space, that is practically unheard of. That is the ultimate moat. And a massive driver of this retention is their embedded field engineers.
Right.
Agilent literally stations its own human engineers, physically, inside 19 of the top 20 pharma companies.
That is wild to think about. It's like having a mechanic actually living in your garage.
No.
Before your car's engine even starts making a weird noise, the mechanic taps you on the shoulder and says, "Hey, I noticed your spark plugs are about to go. I already ordered the parts from my boss. They'll be here tomorrow."
That is exactly the brilliant compounding loop here. By embedding their own humans inside the client's lab to fix machines, optimize workflows, and manage inventory, Agilent gets paid by the client to perform daily surveillance on what those clients need to buy next.
It's genius.
Those embedded engineers generate 30% of all Agilent sales leads.
And because those leads come from a trusted insider who knows exactly what the lab needs, they convert at twice the normal rate.
They've also digitized a huge chunk of this relationship, right?
Oh, yeah. Digital orders now account for 40% of all their orders, totaling $1.2 billion. When you combine a 90% retention rate with that kind of digital efficiency, it creates a massive cash-generating machine. So how much of that cash is actually making it back to the shareholders?
Quite a bit. In Q1 alone, Agilent returned $224 million to shareholders. That breaks down to $152 million in stock buybacks and $72 million in dividends. Plus, they maintain a highly flexible 0.8 times net leverage ratio.
And for the non-finance folks, a 0.8 net leverage ratio just means their debt is incredibly low compared to their earnings. They could pay off all their net debt in less than a year if they really wanted to.
Exactly.
That gives them plenty of dry powder to go out and do more massive M&A deals like Biocare without overextending themselves.
We do need to take a step back, though. I mean, this flywheel sounds almost too perfect. To be responsible guides through this research, we must pivot and examine the immediate threats that are currently testing Agilent's armor. The macroeconomic environment is turbulent, and no company operates in a vacuum.
Let's look at the geopolitical headwinds first, because they are significant. There is real margin pressure right now from new 50% tariffs on certain imported goods.
Yeah, that's a big hurdle.
On top of that, there is an emerging threat from local Chinese manufacturers. China is currently pushing domestic anti-involution policies.
And just to clarify that term, anti-involution policies are China's attempt to stop destructive domestic price wars. The government is heavily favoring local high-tech production and really encouraging domestic labs to buy from domestic instrument makers.
Right, which directly threatens Agilent's market share in that region because local competitors are given this massive home field advantage. Now, management claims that the Ignite operating system will fully offset those 50% tariffs by the end of the year through that regionalized supply chain we talked about earlier. But I have to push back here on another major risk hidden in the segment data.
Okay, let's hear it.
Their academia and government segment, A&G, declined by 8%. And that drop severely dragged down their genomics and cell analysis portfolios. Isn't that 8% drop in academic funding the real canary in the coal mine here?
Whoa.
Because academia is where tomorrow's blockbuster drugs are actually discovered. If universities stop buying equipment today, doesn't commercial pharma eventually hit a wall a few years down the line?
If we connect this to the bigger picture, we can evaluate the true severity of that risk.
Yeah.
You are entirely correct that a slowdown in academic research eventually impacts the commercial pipeline. However, academic funding is inherently cyclical.
Right.
It's tightly bound to government budgets, grants, and political cycles, which ebb and flow constantly.
So it's a temporary freeze, not a structural collapse of the industry.
Yes, and more importantly, Agilent's immediate massive revenue base is overwhelmingly anchored to commercial pharmaceutical manufacturing and quality control. As we saw with the GLP-1 boom, commercial manufacturing is firing on all cylinders right now.
Ah, I see.
So while a freeze in academic funding might slow down long-term pipeline discoveries, Agilent's near-term cash flows are heavily insulated by the sheer volume of commercial production required today. They are very well positioned to ride out the academic softness while they wait for those government budgets to inevitably thaw.
That makes total sense. So weighing these geopolitical and academic risks against their 90% retention rate and those massive GLP-1 tailwinds, we arrive at the final strategic outweigh. The consensus verdict from the analyst reports we reviewed is a strong BUI.
Yes, analysts are very bullish.
Analysts, including Goldman Sachs, who are projecting a 19% upside, currently rate the stock a buy.
And the core thesis for that: buy rating rests on an ongoing biopharma instrument replacement cycle. Labs are constantly sourced to upgrade to faster, more efficient tech just to keep up with production demands. The analysts point specifically to the rollout of Agilent's Infinity III liquid chromatograph.
The Infinity III, that's the newer, faster version of those microscopic chemical filters we discussed earlier, right?
Exactly. The Infinity III boosts customer productivity by an astonishing 30%.
30%, that is a massive jump in efficiency.
It is. When you combine a massive hardware upgrade cycle like that with their highly disciplined capital deployment and the sticky recurring revenue from CrossLab, Agilent is positioned for highly reliable double-digit earnings per share expansion.
It's a remarkable transformation, really. They took a cyclical, unpredictable hardware business and turned it into a deeply embedded utility.
To synthesize this entire deep dive, Agilent has fundamentally evolved.
They are no longer just a hardware vendor dropping a machine off at a loading dock and driving away.
Yeah.
By embedding their software, their highly specialized consumables, and their actual human engineers into the daily workflows of the world's most critical industries, they've become the central nervous system of global lab operations.
Before we wrap up, what is a final angle for the listener to consider as they look at this company moving forward? What isn't fully priced into the analyst models yet?
Here is a fascinating tension to ponder. As Agilent leans heavier into artificial intelligence and digital automation, which, by the way, is a stated primary goal of their Ignite operating system for 2026, what happens when the very lab productivity they are optimizing begins to require fewer human scientists?
Wow. You mean AI running the diagnostics and maintenance instead of the embedded human engineers?
It's exactly.
Will Agilent's embedded field engineers eventually be replaced by Agilent's own AI platforms? I mean, if they can completely automate the maintenance schedules and the supply ordering without human intervention, that could push their cross-lab margins even higher. It would be incredibly profitable.
Right.
But could a frictionless AI interface eventually sever the deep human intimacy and trust that currently drives their incredible 90% customer retention rate? It is the ultimate balancing act between technological efficiency and human relationships.
If the mechanic moves out of your garage and just sends you an automated text, do you still trust the recommendation?
Exactly the point.
That is something you should definitely keep an eye on as this plays out. Thank you for joining us as we unpack the shifting landscape of global lab economics. We hope this framework empowers you to look at your own investments and strategic thinking with a sharper, more critical eye. Risk defined, portfolio protected.